Hey friends, welcome back to the channel. My name is Sanji and today we're going to look at what is the ideal combination for VAS and VGS in a portfolio where you just have VAS and VGS. Now this is a question that hasn't come up that often, but I've seen it come up on both Reddit and on a few other forums where people want to get started in the investing area and they know VAS and VGS are a good combination, but they're not sure what's a good balance between the two to have. So in this video, we'll have a quick look at what's generally being said on the internet. Then we'll have a look at what's actually being said when you look at the data and you actually run the numbers in terms of return and risk and look at where would be a good combination if you wanted to say minimize your risk but try and maximize your return on this. We'll also finish with a few considerations for the everyday Australian, because it's one thing to know what the ideal combination is, but then how do you practically translate that in terms of rebalancing and how frequently you need to, and should you just have a range instead of having just two numbers you're always trying to hit? So we'll get into that as well. So let's get into it. So VAS and VGS are considered two great ETFs to get started with because between the two you get exposure to the whole world. So with VAS you get exposure to the top 300 companies here in Australia, and VGS gives you exposure to about 1,500 companies across the world, excluding Australia. So you do get that worldwide exposure, but you do also introduce a bit of currency risk through VGS. So when you look on the internet generally around this topic, you see something between 50-50 and 60-40. And that's actually pretty aligned to what I also said in my video, which is around 50-50 is probably a good starting point. So 50-50, I think I've seen the Barefoot Investor talk about in terms of that's a great way to start. And generally on the Reddit forums, I've seen that 40-60, 60-40 split, whichever way you want to call it, between VAS being the lower one and VGS being the higher one. So have a bit of a international edge to your portfolio. So what I essentially did was grab the returns data for VAS and VGS across the last 5 years. And that was actually total return. So I had some help with that. Thank you, Sam. You would have seen Sam appear in my videos, very smart cookie. And what he essentially did was he put together both the capital gains returns and also the returns that come from distribution. So it's all inclusive in terms of returns. Looked at it across the last 5 years in terms of both the returns and the risk and what that looks like across the different universe of combinations you can have for VAS and VGS. So all the way from 0% VAS to 100% VGS down to 0% VGS and 100% VAS. And when you plot it out on a risk return profile, this is what you see here. So each dot on the line represents a different portfolio composition. So the bottom right one is 100% VAS and the top middle one is essentially at the other end of it, 100% VGS. Now immediately you see a few key features of the graph and I'll call it out. So the first thing you can see is that bottom right position is essentially saying having a portfolio where you're just invested in VAS relative to being invested in VGS is saying you have taken on board more risk and less return than just investing in VGS. Because look at that. If you invest in VAS, you get 17% standard deviation with nearly 13% returns, and with VGS you get less risk at around 14% and 15% in terms of returns. So that's the immediate key takeaway you see here. So then you're wondering, well, what would be the ideal combination? It's probably going to have more of VGS in it. And the other thing to note with these kind of graphs is actually understanding what's going on as you go from the right to the left. So when you've got VAS there at 100%, as you go along the line and you go another notch to the right, where you go from 100% VAS to 95% VAS, what you're essentially doing there is you're taking on board more returns for less risk. That's what it's saying, is as you go along that curve up to that end point where I've labeled 60% VGS, is every addition of VGS into your portfolio and the relative reduction of VAS, let's say, results in you taking on board less risk and getting more returns for it. That's ideal. And that's often why when you see these graphs, people will often generally only plot out the top half of it, because the bottom half is just considered inefficient, because you shouldn't have a portfolio where you're overweight VAS basically in this combination, because you're going to be taking on board more risk and less returns. The next key feature is a minimum point that I've labeled there, where you've got the least amount of risk, which is where you've got 60% VGS. And this is, I guess you could say, this is the ideal portfolio composition if you wanted to reduce risk, where you got 60% VGS, 40% VAS, and you're basically taking on board the least amount of risk and you're getting quite a good return, around 14%. Now, I will quickly call out, we're not talking about massive differentials in returns, and I understand some of you would have picked up on it. We're talking about the difference between 13 and 15% returns. But it's the idea of the portfolio composition, the risk-return balance that I'm trying to get across here. So now looking at the second half of the graph, what you're essentially seeing is that minimum point, 60%, is where you'd consider the least amount of risk for a decent level of return. So you're getting about 40% return and you're getting much less risk, or the least risk in terms of this combination in portfolios. And that could be where the Redditor crew are coming from when they've done the analysis and they've said 60-40 is a good split because you're getting the least amount of risk for a good return. Maybe, hopefully, that's where it's coming from. Because what the graph is saying is, if you take on board more VGS than 60% VGS, you are taking on board more returns, but you're taking on board at the cost of more risk. And you can see as the line starts to flatten out, that gradient is essentially implying that you're taking on board relatively more risk for the return that you're taking or you're getting as a benefit. So what does this mean for an everyday Australian who's just started their investing journey, or is, decently in and wants to get a bit of an idea of this whole idea around portfolio composition? First thing is, I would say, is VAS VGS is still a great combination, but you want to be overweight, or you want to be leaning more towards VGS. You want to be leaning more towards international shares, because it seems you get less risk and more returns, or more returns for less risk. That's the key thing I would call out, because you don't want to be slipping and sliding down that graph going towards the bottom right end, because then you're basically taking on board less returns for more risk, which is not great. So that's probably the key thing. The second thing would be, realistically, I think for most people when they're investing in the share market, they only invest once a month or once every couple of months, because it takes a while to accumulate the money. You don't want to get burnt on brokerage, so you wait till you have a decent amount and then you put it into the share market. What can happen in terms of the balancing of your portfolio in that time? If you start with a 60-40 portfolio, will it suddenly go out of whack and you have to start rebalancing very quickly? Well, realistically, it looks like, most of these ETFs are going up about 15-12% per year, which is going to be around 1% a month. So realistically, I think if you start with 60-40, it's going to take quite a while for that to go out of whack. I'm speaking in terms of averages. But if you do start to see as your 60-40 split start to go in the direction of VGS going a bit higher and VAS therefore going a bit lower, what it essentially means is the next time you invest, you put a little bit more towards VAS instead of VGS. And, vice versa. If you start to see your portfolio going a bit too much in the direction of VAS over time, Australia starts having a good run. If you want to be true to your portfolio composition and your target portfolio, it would essentially mean you just put more towards VGS. Now, in this kind of situation, I always just try and invest in one ETF at a time. So I'm saying that, so say you have $3,000 and you want to invest in this kind of portfolio, I would be generally buying one ETF rather than two ETFs. So I wouldn't put like 1,500 into VAS and 1,500 into VGS. I would just put 3,000 into one in the first month and then 3,000 into the other in the other month, because I know the portfolio composition is not going to change that much between 2 months. Naturally, when I do a video like this, I know I'm going to get a question around, hey, can you do more than 2 ETFs? Can you do this combination, etc., etc. First thing I would say is this is not that hard to do yourself if you are interested. You're basically plotting out the efficient frontier curve. Go onto YouTube, type it in, tutorials, there's plenty of tutorials, I'll leave a link below on that. It's good to know how to do it yourself, because then you get a feel for the different compositions and what matters in terms of ETFs you're looking for. The other thing is, if you are really interested in a certain combination, leave a comment below, and if you see someone else with the same kind of idea, upvote their comments, so have a general idea of what's considered popular. And then I'll either do a video in the future or I'll do an article on my website, sanjisen.com, where I'll sort of plot it out and leave it there for you to have a look at there. So with that being said, please do consider also subscribing to my newsletter. That's probably where I'll give you a heads up that I've actually done the analysis on some of those other combinations and post it on the website. And the other thing is check out my other videos, especially I did do a video, if you are new to investing, I did do a video around VAS and VGS and why it's a great combination, but also check out some of my other videos on ETFs as well. I'll see you in the next video. Bye for now.